Good morning and welcome to your Tuesday, June 11th market news update. UK's unemployment rate rises for yet another month, but wage growth remains robust. Natural gas prices hit 6-month highs on projections for higher demand amidst the summer period. The greenback stays near 2-week highs, albeit the slip in bond yields. Crude futures climb to the $77 per barrel level, and traders now await for OPEC's monthly report for clues. Earnings from Oracle to attract equity traders' attention in aftermarket hours. Yuan traders brace for China's inflation update in tomorrow's early agent session. Finally, UN Security Council backed an Israel-Hamas ceasefire plan. That's all for now, and stay tuned for tomorrow's market update.
Hi everybody and welcome to another daily presentation. This is the market overview for the 11th of June of 2024, and these are the key events that you should familiarize yourself before starting your own trading day. Now, the first and sole topic of the day is going to be about the latest update for the UK's labour market, which we have received earlier today. So the latest update on the UK's employment market further complicated matters for the Bank of England, but also for the ruling coalition, the Conservatives, as the central bank has explicitly highlighted that it is watching closely the developments in the job market to decide whether to cut and when, to cut rates and at what time. So the report highlighted that labor market is indeed cooling down as less and less jobs are being created. This was evident from the employment change for the rolling 3-month period. The unemployment rate is indeed creeping higher and higher, and it has reached the 4.1% level, if I'm not mistaken, earlier today. People do file for unemployment benefits, and this number is on the rise, but at least wage growth continues to evolve steadily to the upside, which is the only positive development when it comes to the UK's employment market. Now, the pound fell slightly post the labour market update as it offered evidence to investors that the Bank of England will abandon its strict stance and pivot to looser financial conditions later this year. And we highlight that the fall was not that much, although the fall was not that aggravated, mainly because of the print, or at least the data point from the wage growth. If wage growth stalled, we would have had a different picture when it comes to the pound. Okay, so rises in the unemployment rate seem to garner the move for a cut by the Bank of England as the unemployment rose to the highest level since September of 2021. This is definitely not a good sign or a good outlook for the UK economy. Maybe this is going to be one reason why we're going to see Bank of England policymakers cutting rates in probably the September meeting. Let's not forget that headline inflation in the UK has eased to the 2.3% level. What was it? The May meeting, not meeting, but in the month of May. Core CPI rate, however, remains elevated, if I'm not mistaken, somewhere around the 3.9 or 3.8% level, so 2 times higher than the bank's 2% target. Maybe the other reason why we're going to see hesitation from the Bank of England, but still, CPI print is going to be inbound within the next few weeks. We will see how that front behaves. So we have one front being inflation, the other one is employment. The employment market does, quote unquote, allow or does make policymakers, Bank of England policymakers to reconsider their stance and possibly pivot towards looser financial conditions. We will see about this. So, in regards to the pound OIS probabilities, they are in favor for a rate cut of 25 basis points in the September meeting, which is the sooner that the market sees the Bank of England cutting rates. So if it comes into fruition, this cut, the central bank will have a key policy rate of 5% near the end of the year, assuming that there will only be one cut and no more than that. So we will see depending on incoming data. Lastly, we have to finish by saying that citizens of the UK will head to the polls next month on the 4th of July, paradoxical but still, who are going to vote essentially for parliamentary elections who shall represent them going forward. And according to early opinion polls or recent opinion polls, we see Keir Starmer, the leader of the opposition party, the Labour Party, becoming the next prime minister, mainly because we have seen Rishi Sunak vowing to restore employment conditions in the United Kingdom, at least tame inflationary pressures at the same time, mainly because he has a background in economics. Inflation, yes, you may see that, we may say that has been brought to a desirable level if you exclude the core CPI from this kind of observation. However, the employment market is definitely not drawing a nice picture of Rishi Sunak, so we may see him being ousted in the upcoming elections. We will see how the Labour Party is going to take over and address this kind of issue. Okay, for the time being, this has been the end of today's session, guys. Thanks for watching, and we will catch you on to tomorrow's session for hopefully another brief update. For the time being, take care. Bye-bye. Welcome. Hello, everybody. Give me 1 second, please. What do we have here? So, welcome, guys, to another T4Trade webinar, the rebooted kind of series we had over the past year or so, a couple of times. So, I see people joining in. That's very good. Welcome. Also, we have here Mario. Hi, Mario. Hi, Ibrar, excuse me. I see Nikita, Nicole, much probably. I see John. I see, who else is here? I see lots of people tuning in. Hi, everybody. Welcome. So, before we head in and start our topic, which is obviously the second session of our newly rebooted kind of series, let's give a little bit more time for other people to join in. That's one. And secondly, for those of you that have already joined this kind of webinar, can you please, guys, let me know whether you can hear me loud and clear, whether you can see the first slide of the presentation. Okay, it's kind of irrelevant whether you can see me or not. That's a bonus. So thank you for the confirmation, Ibrar. Thank you. You can hear and see the presentation clearly. Perfect. Okay, so thank you for the confirmation. Thank you for the confirmation, guys, as well. Thumbs up coming in. Perfect. So since we have our setup up running correctly, okay, and you can hear me loud and clear, let's indeed make a quick start. And for those that will be joining shortly after, we will do a small recap as we progress, depending obviously when they're going to tune in. So this is the second webinar of our series. Is going to be about technical analysis. On the prior one, we have done, in a sense, a small summary of what trading is in general, super basic stuff. We introduced some sort of concepts. We said what kind of trader you can become, or depending upon your schedule and your time that you have free available in order to invest in trading, because you need to have quite some time allocated to trading. Firstly, learning the basic stuff, and then setting up a schedule or a trading kind of strategy, okay, that will allow you in a sense to excel. So in today's webinar, we're going to do intro to technical analysis. Again, super basic stuff, okay? So we're going to introduce, in a sense, what topics we will be venturing in much more deeper throughout the series. So introduction, technical analysis, let's begin. Before we do so, this is a quick risk warning and a disclaimer for you to read at your own time. I'm not going to go over it. So in a sense, let's get straight to the point. What's the time? Okay. So what we will go over in this session is going to be, this is the agenda for today's session. So in a sense, we're going to provide a definition of what technical analysis is. Okay. What kind of different types of technical analysis are there, which might work best for you, and in a sense, combining them together, meaning that stuff that fall under each and every kind of approach we will discuss. Today, we're going to probably venture into what kind of technical indicators, which are the prime tools of a technical analyst, can be used in your own trading journey in order for you to have much more accurate kind of entry and exit points, in a sense, to grasp and identify the trend of the market, trade not against it, but with the market, with the flow, in a sense. And these kind of indicators provide you with this kind of necessary information, if you will, like, okay, at least additional information that can be used for your own benefit. So what is technical analysis? The formal definition, in a sense, of technical analysis is a study of market action through the use of charts in order to forecast future price trends. In a sense, you look at a chart which plots, in a sense, price of a specific instrument against time. This creates, in a sense, what we call a chart. Either it's going to be a line chart, bar chart, or candlestick chart. It conveys the same kind of information. Price changes of price against time. This is what technical analysts, in a sense, study, okay, directly, indirectly, with the use of technical indicators and many other measures in order to give them, let's just say, again, valid information of how to trade much more accurately, once and if and only if you understand what kind of information is conveyed by these additional tools. Okay, so we will do that throughout our series. Okay, so market action, in a sense, includes three elements, and these are price, which can be obviously seen via a chart, on a chart, which plots the price action of the movements of a specific instrument over a period of time. We'll also be dealing with volume, okay, which is another key aspect of trading that needs to be studied. And for the time being, open interest, another key secondary kind of indicator, or if you would like, or piece of data that is used primarily by technical analysts in order to gauge how the market is behaving and, in a sense, try to understand its psychology at any point in time. Okay, So technical analysis can be used in a sense in all time frames for either short-term, medium-term, or long-term trading, and it can be used by pretty much each and every one of those classes of traders we have discussed on the prior session. So either scalper or day trader or swing trader or long-term trader. There's a bunch of them out there. So each and every one of those individuals that call themselves traders, okay, they use technical analysis in order to capitalize on the fluctuation of price movements, make money on that. Uses, in a sense, the charts that are freely available to them in accordance and in addition with other indications in order to do their business. Okay, so it can be used for either short, medium, or long term, depending on what kind of trader you are. Obviously, you're going to have a specific kind of time frame that you will be operating upon, or at least the period of study for you as a whatever kind of trader you are is going to be dependent, okay, upon obviously the information that you have in front of you. Okay, so technical analysts develop trading rules and trading system by using various theories, charting tools, and indicators. Okay, so we will discuss each and every one of them as we progress through the series. Okay, so today, remember, it's going to be a brief introduction into technical analysis. Nothing superbly kind of difficult will be discussed here. We are trying, in a sense, to lay the fundamental ground where we're going to build upon our, let's just say, knowledge. Okay. So there are three principles of technical analysis, and if you buy or have access to any technical analysis handbook, you're going to find these kind of written kind of rules. Okay, they all stem from Dow theory, John Dow, back in the early 20th century, where he kind of developed this idea of the price movements in the markets while using technical analysis tools. He observed specific rules, quote unquote rules, and not written in stone. Then he came up with a few principles that we still use to this day when we do technical analysis. So the three principles of technical analysis are, in a sense, the market discounts everything. Okay, so any new financial incoming data, okay, new financial news release or economic development or geopolitical development is implemented and incorporated in price action at the time of the release, okay? And the market therefore assesses incoming data or goes even a step beyond that, attempts to forecast where specific economic developments will venture towards to in the future, and they move towards that by interacting in a sense with the price of any given instrument. So the all past data is already incorporated in the prices, and therefore they go a step further and they attempt to, in a sense, bring the future into the present by coming up with specific projections, positioning themselves accordingly. And once that date comes where, for example, you're going to have a release of a GDP of the United States in the next few weeks, they produce, in a sense, a forecast. They move the market. They implement their objectives, their assessment, their outlooks into the price action by buying or selling, depending the instrument. And once that time comes where we get that specific release, the GDP, for example, and they see there has a greater variation between what they expect and what they actually came out, they adjust their horizons accordingly. Okay, so the three principles are, once again, market discounts everything. The price moves in trends. Okay, and the history in that history tends to repeat itself. Okay, so the second point is prices move in trends. This is one of the prime cornerstones of technical analysis. Technical analysts believe that price indeed moves in trends, and therefore once you start identifying those trends and study them much more closely, you can, in a sense, anticipate whether the market or the market in general or a specific instrument will continue to move to that desired direction, that already established direction, or it's going to turn away and move the other, okay, the other way. Okay, so history in itself tends to repeat itself. This comes from a kind of a cyclical kind of time series analysis from the past. If you go, for example, back in the 1970s and you study the price action of any given instrument back then, you're going to see some sort of similarities of what happened with 2022 or 2021, 2023, 2022, 2023, where we saw, for example, at that point in time in 1970s, we saw a spike of oil prices due to an embargo, mainly because of a war in Middle East between Israel and Egypt at that point in time, and many other nations got into that as well. We saw an oil embargo to the United States that, in a sense, pushed the prices of oil to high ground, which created, in a sense, higher inflationary trends or tendencies. We saw inflation skyrocketing, and that at that point in time, the only thing that the Federal Reserve, the central bank of the United States, had to do was to increase rates or hike rates in order to contain that rogue inflation. We see a similar scenario has been taking place since 2022. High inflationary pressures across the world led to many central banks, nearly all of the central banks, to start hiking rates. Okay, so you see the same kind of underlying structure underneath the system, and this kind of gives value, or at least validates this kind of point that history tends to repeat itself. And once you study the past enough and accumulate a large data set of knowledge that has this studied or observed kind of examples or events, you can extrapolate that in the future, once you start seeing similar kind of trends moving in the same direction, marching in a sense a pattern that happened in the past, you can capitalize upon that. So in a sense, those are the three key principles. I'm going to repeat them once again, and then we're going to move on. Market discounts everything. Price moves in trends, and history tends to repeat itself. Okay, these are the three main tenets of technical analysis as an approach to trading. Okay, so what are the different types of technical analysis are there? Okay, so I have personally split this topic into two for the sake of digesting this information much more faster and much more clearly. So there are different types of technical analysis. I split it into two sections: charting analysis and mechanical analysis. We're going to discuss what falls under each. For example, charting analysis uses primarily what we call the key or the fundamental kind of tools when it comes to trading, which are support and resistance levels or lines or areas. Okay, they implement the use of trend lines. Okay, which we're going to go over. All of these will be walked through as we progress throughout the series. By the way, we have to note this. They also use channels. Okay, either upwards, sideways, or downwards moving channels. We're going to see that. Chart patterns. Okay, so the commonality in regards to the charting analysis, in a sense, you have the price action, which we just mentioned. On the x-axis, you have time, and on the y-axis, you have price. So in a sense, charts are representing price movements or price fluctuations across time, which creates these kind of patterns, which we study as technical analysts. And when you use, for example, the approach of charting analysis, you primarily are concerned with obviously the price action, the chart price action, and therefore you draw these specific kind of tools on top of the price action. Okay, nearby candles or nearby bar charts or nearby whatever that might be, whatever type of chart you're using, in order for you to create an understanding of firstly where the market is moving towards to, market meaning also any given instrument. Okay, and where we may find some sort of levels of potential resistance where you see a lot of bears kind of accumulating power and waiting for the bulls to bring the price action to that level. And therefore, that's why we use upon resistance levels, trend lines, channels, and chart patterns. Okay, so the other quote unquote other approach is mechanical analysis, which in a sense uses technical indicators such as moving averages, oscillators, bands, and envelopes, and other technical tools, in a sense, to uh, enhance, okay, our clearing, or if you will like, our vision of when to spot specific stuff on the chart. Moving averages are, if not the most widely used tool, technical indicator on charts, and of the most, okay, if not the most, okay. And these specific one, moving averages, go on top of price action, much like charting analysis, but it's an automated kind of indicator that you don't need to draw by yourself. You just input the specific parameters. We're going to be going through the process, don't worry. We also have oscillators that most of the time go below your chart. If you pull up, for example, a CCI channel index, you're gonna see it going below the price action. It's not going to be on top, okay, of candles or bars or lines on your chart. It's going to be below. It's a different segment on your trading kind of setup, okay. But nevertheless, they, in a sense, mechanical analysis tools are primarily used to gauge, okay, the momentum, what we call momentum, or the sentiment of the market, by using these predetermined kind of tools with specific time frames in order for you to, in a sense, understand, okay, where the market is moving towards to, or validate whether the market is moving towards to, okay, or whether we're going to see some sort of pivot or a reversal towards a different direction, okay. These are the tools that technical analysts use in order to validate their assessments, no matter what they are, okay. So you first start with charting analysis. You plot all this lovely stuff on your chart, establish where the market is moving towards to, then you add on your other technical indicators, which fall under the mechanical analysis kind of branch, if you would like, and then you get validations or confirmations, or on the flip side, divergences and all that kind of stuff that tell you, pay attention, we may see some sort of moving away from it, okay. So these are, in few words, definitely no few words, what type of technical analysis approaches you can undertake when you use this kind of stuff. Okay, so types of charts. Super basic stuff. We have many different types of charts. The three major ones, in a sense, are, and they have their own uses. Three main ones are line charts. The other one is bar charts, and the last one is candlestick charts. We're going to go over them in a little bit more detail in the next few slides. So line chart, obviously, if you pull that up on your platform, you're going to see that the line chart is, once you put them all three together, you're going to see that the line chart is the simplest form of chart plotting, okay, or price plotting on a chart, okay. The line, in a sense, consists of only, okay, obviously one line, okay, and connects the price action or the movement using only closing prices. All the other charts we will be discussing throughout this webinar today are incorporating much more information compared to the line chart, which is the simplest one. So all you need to know is that line chart obviously connects the dots of prior past closes. They don't incorporate information about how high did the specific stock, or for example, Apple, went throughout these day yesterday, or how low it went, or where it opened. It only conveys information about the close prices. Okay, so it has that property, if you will like, which is used on super specific scenarios. The line charts are pretty much outdated. They're only used for visual inspection and confirmation for many larger kind of market moves. Okay, so it doesn't provide any information about the trading range during the selected time interval. We have just mentioned that. Therefore, it's obviously, as we just mentioned from the beginning, super simple and the simplest of them all. Okay, so next one is going to be the bar chart. Has been used extensively throughout the 20th century, has been the gold standard, if you like, of charts. but that time came where we saw the rise of candlestick charts, which pretty much each and every one of technical analysts used throughout its day. Maybe some people are still using bar charts, fair enough, but the majority of traders today, they use candlestick charts mainly. You're going to see the reason why. Okay, so bar chart, you can see visual illustration on your left hand side on the screen. Okay, as it says, bars. So you have, in a sense, two types of bars. Which one? The first one is the bullish bar, okay, and the other one is the bearish bar. So on the right hand side of the screen, you can see that most of the times, okay, irrespective of the color, you have a few properties that distinguish between, you can distinguish whether the bar on your chart is a bullish or a bearish bar, okay? And the main distinction, okay, is that whenever you have a bullish bar, and in this case, we have highlighted it as green, okay? So you have I don't know if you can see my mouse pointer. Hopefully you can see my mouse pointer. Okay. Or this is on the right hand side corner of this slide underneath the bullish bar. So in a sense, how you can distinguish the bullish from the bullish bar in a sense has a higher, okay, close than the open price. So the open price, or in other words, the open price is lower than the close price. So you can obviously infer that by looking at a price chart. Whenever you see, for example, something else I have to mention is that on bar charts, the open price is always denominated or signaled or seen, okay, by this lovely line on the left hand side of the bar, whereas the close price is on the right hand side of the bar. So whenever you see this lovely, let me highlight this for you for convenience, I'm talking about this lovely extrusion right here. Excuse me. The open price is always denominated or found the level where the price action has opened throughout the day on the left hand side, okay, whereas the close price is always on the right. So whenever you see this lovely line being of the open price being below the close price, this is certainly a bullish bar. On the flip side, if you have an open price left hand side higher than the close price, then this means is a bearish bar. Okay, so pretty self-explanatory, super simple. Okay, so you have the description right here once again. So a bullish bar, you have the open price lower than the close price. Okay, open price lower than the close price, and the bearish bar, you have open price higher than the close price. Okay, that's how you can distinguish this kind of what type of candle it is when you look at this. Okay, so some people like to color their bar charts. Fair enough, simple. No matter what kind of color do you have, remember the basic principles or the basic tenets of each and every bar. For example, as we just mentioned, these are, where is my mouse pointer? This is a relationship that you need to have instilled in your memory. Okay, so whenever you see open lower than the close, bullish. When you see open higher than the close, that's bearish. And both of them have some specific implications we will be discussing throughout this session and many other sessions going forward. Okay, so next up is what the majority of technical analysts or traders use in this day and age, what we call candlestick chart. Okay, candlesticks, they are have been primarily introduced into the financial markets or the technical aspect of markets by they have, in a sense, Japanese influences. Therefore, once you start Googling candlesticks, you're going to have the name of the country before it, which is going to be Japan. So it's Japanese candlesticks. They were introduced by Japanese merchant named Homa back in the 17th century. That's irrespective. as a history lesson, but keep that in the back of your mind. So in a sense, bar charts and candlestick charts convey the same amount of information. Oh, sorry, I failed to mention this on the previous slide. You can see that the bar charts are also conveying information such as highest and the lowest, whereas if we go a slide backwards, line charts only use closing prices. That's why we call bar charts much more superior than line charts, and that's why afterwards we call candlestick charts, okay, or candlesticks in general, much more potent, quote unquote, potent than bar charts, because they're much more nicer when it comes to the eye and much more easier to spot specific price movements of any given kind of instrument. That's why majority of people use candlestick charts for visual inspection, much more faster visual inspection. So the area, let's go over the components. So the area between the open and the close, so you have the same kind of relationship here, even though you don't have this kind of annotation that the bar chart had. Okay, those lovely handles that was on the left hand side open and the right hand side closed. In this kind of charts, you have the open price and the bullish candle being formed once again once the open price is lower than the close price. Okay, and most of the times bullish candles are painted green. Okay, so again, color is not something super important. You can color them purple. For example, the bullish ones, you can color them purple, and the bearish ones, you can color them yellow. Doesn't matter. The point is the information that is contained within each and every candle. Okay, so understand how to visually inspect and understand what has happened throughout that specific time period that each and every candle represents. Okay, so again, open price lower than close, you have a bullish candle. Open price higher than the close price, you have a bearish candle. Okay, so something else we have to mention is that you see this block. Okay, this is what we call the real body of the candle. Okay, which is the explanation right here. So the area between the open and the close is, okay, in a sense, what we call the real body. In a sense, this is where it has opened, this is where it closed, this is the trading range within the day, plus the candlesticks in general have what we call excursions, okay, above and below the real body. So if this is the real body, these are the excursions we're talking about. So they vary in length and they have different interpretations depending whether, for example, you can look this candle, you see a longer shadow, okay? This is what we call a shadow. So the length below the open price, so the lowest the price action has went through that specific time period is what we call wick or shadows. There is a lot of different terminology about this, but they convey the same kind of information anyways. Okay, so wick, this is the stuff that you light up the candle, the actual candle in real life. Okay, so mainly you call this on the top a wick, and the line below the open price, depending whether it's open price or the close price. Okay, the lowest price has reached throughout the day is what we call shadow, but they are interchangeable. You can use the term shadow or wick or tail, whatever that is. You convey the same kind of information. Where is the highest and where is the lowest point that price action has reached within the trading session, but they has retreated from. Okay, so obviously in order to create wicks, you need to have some sort of moving backwards of price action. Okay, candlestick charts are indeed visually superior to bar charts, even though they convey the same kind of information, and definitely much more potent and more visually superior than line charts that we discussed in the second to last slide. Okay, so this is the primary tool of preferred method of conducting technical analysis from traders throughout this day and age, in a sense. Okay, so from here onwards, we will be conveying information and discussing charts primarily with this chart hype. candlestick chart. Okay, so hopefully this information that we have gone over in the past 3 slides is understandable. If not, please let me know in the chat. I will go over once again and discuss if you have any kind of queries about this, because these are the, in a sense, the essential ones that we need to learn from day one. Okay, so moving on to the next segment of today's brief introduction to technical analysis. This is charting analysis, and we have mentioned support and resistance levels. We're going to have a dedicated webinar using all of this lovely stuff throughout the series. So deep dive, into support and resistance levels. We're going to go in a live environment as well and start plotting them together to see which ones are valid, quote unquote valid, because they have some sort of tick boxes, if you will like, that you need to check before you plot them on your chart. You don't go on your chart and just plot support and resistance levels wherever you see fit. Okay, obviously it's subjective. You place them where you see fit, but there are some sort of rules that you need to abide by in order to have a much more sophisticated or much more accurate kind of view of where is actually a support or resistance level that may come into play in the near future. Okay, trend lines, we're also going to go on a separate kind of webinar and do that as well. Okay, super simple, but they have some specific implications. We're going to draw basic trend lines. We're also going to do speed lines. You're going to use Gantt fans. If those are some things that you are not aware of, if you are not, we're going to discuss them as we go into other sessions. Okay, so channels are something else we're going to be discussing, how to plot a channel onto your charts with a correct way, because you can see many people not doing it the correct way. We're going to state the parameters of what constitutes a correct, quote unquote, channel, and what kind of implications arise when you see a break above or below a specific channel area or a congestion area, as we call, or trading range. And therefore, in a sense, do that on a live environment and see, you know what, we can have entry and exit points using this kind of channel. This information that is conveyed with the channel is pretty much, quote unquote, predictable, and I can capitalize upon that. We're going to do that. Okay. So, and the last part from the charting branch of analysis, it's going to be chart patterns. We're going to study this lovely stuff in much more details. So candlesticks individually, we're going to go over candlesticks, Japanese candlesticks in much more depth, because they constitute the majority of technical analyst kind of occupation, if you would like. Okay, so understanding what information that each and every one of candlestick formation is conveying to you is certainly a key to your successful journey when it comes to trading. Okay, then once we identify them individually, okay, and understand how they are formed and what kind of information they convey, we're going to put a few of them together and going to start looking at chart patterns, okay, or candlestick formations, in other words, and going to zoom out further more than that and start looking in general kind of what kind of patterns arise with the accumulation of candlesticks together. Are they conveying some sort of message that we can capitalize upon when we trade, or is he confirming our own biases that, for example, the price action is going to move to that already established direction? Okay, so we're going to go over, for example, I'm just going to give you a sneak peek. In regards to chart patterns, we're going to do morning star formation or evening star formation. We're going to do three white soldiers, three black crows, which are confirmation and reversal kind of patterns. You're going to see them. We're going to do, for example, head and shoulders, double tops and double bottoms, what we call the saucer or the cup and handle formation. We're going to study a lot of them, because these are indeed the fundamental aspects of each and every one of successful traders, technical traders out there. Once you master those and then you add on the technical indicators, you can certainly cover a lot more ground, much more accurately, and become much more profitable. Okay, so these are the essentials, and we have to spend a lot of time on them in order to master this kind of skill, if you would like. Okay, so that comes obviously with time. I'm going to introduce with you this kind of concepts in future webinars, as I just mentioned a million times this webinar. Okay, pardon me if I'm repeating myself. So on the flip side, on the second kind of category we just had, we have, if I go further back, which is this charting analysis and mechanical analysis. This is what we just discussed. I have just blabbered on about over the past, 10 minutes. Now it's going to be this one. Let's blab on for another 10 minutes about that. Okay. And these are the second approach, which is what we call the on-chart indicators or mechanical kind of analysis. You're going to see I've split it into further categories going forward. Okay, so on-chart indicators are exactly what the name suggests. That's why we use these lovely terms. So on-chart indicators, you see these 1, 2, 3, 4, and there's many of them out there. I've just decided to go with these lovely 4 because are super nice and easy to digest, with the exception of Ichimoku clouds. These are certainly something that needs to be addressed by certain depth. Super complicated, but we will go ahead and discuss that and introduce that kind of concept of Ichimoku cloud, this approach by Ichimoku, in nearing the end of this kind of session, once we go over the basics. Okay, so these are on-chart indicators that go on top of price action. Some of basically the most used one is moving averages, and we're going to do moving average strategies. But before we go into moving average strategies, we're going to introduce the concept of moving average. What is it? Okay, how is a moving average indicator calculated? What specific parameters can be, in a sense, interchangeably, or you can switch and adjust according to your needs. Okay, and after that, we're going to see how to use these lovely moving averages in conjunction with one other plus other technical indicators. For example, we're going to go into moving average strategies, which can be profitable on certain occasions. For example, when the market is trending towards one direction, they're super helpful. Okay, moving averages. Whereas on different kind of non-trending or stagnated kind of price action of any given instrument, moving averages are not that potent. So therefore, we're going to switch to a different indicator that is well suited for that specific period of time. Okay, but for the most part, because moving averages are a trend following indicator, once you have an established trend, they're super, super helpful to your own trading journey for confirming whether the price action is moving to that desired direction, that forecasted direction, or whether a reversal will has taken place. So it gives you indication of shifts of price action. Okay, so moving average are going to be definitely a lovely topic. Okay, super easy to understand and implement as soon as possible in your trading. So we're going to go over moving average strategies using 1 moving average, 2 moving average, 3 moving averages. There's a lot of them. We're going to go over the nitty-gritty details of each and every approach. Okay, so that's one. Bollinger Bands is another type of on-chart indicator that goes on top of price action. This is what is common with these 4 I just outlined here. They go on top of price action, much like this lovely stuff. So chart patterns, the stuff, support and resistance levels, trend lines, and channels, they go on top of price action. You can visibly see that being middled with the price action. Okay. So Bollinger Bands is another indicator that, in a sense, attempts to highlight any potential areas where we see price action or the momentum of that move exceeding what we considered as normal, and therefore that has specific implications which can be used to capitalize upon it. Okay, if my explanation is vague, you will understand exactly what I mean once we get to that, to Bollinger Bands. Okay, Ichimoku cloud, as I just mentioned, is obviously, relatively speaking, the hardest of these kind of methods or tools that are available for you to trade, because they incorporate very different kind of inputs. So for example, they convey information about cyclicality, about time cyclicality, obviously price, volume as well. They have a lot of stuff mashed together, so we need to build up our knowledge base beforehand. Once we go to that, that's why we have it nearly, if not the last session, near the end of the this fresh new cycle, because we have to introduce also Elliott wave theory in order to understand Ichimoku clouds, which is definitely a lot to take in once you are in a new trader that needs to, in a sense, start your journey right now. First, we need to go over the basics and progressively build up the difficulty, if you will like, because once we jump onto Ichimoku clouds, you will not understand anything if you have not any sort of friction with this kind of stuff for the time being. So I'm assuming you are new traders, new to trading, or at least you have spent some time in trading, but some things are not making sense. Okay, fear not. We're going to introduce how all this stuff work and compile them together in order to get that lovely overview kind of effect, okay, which will definitely aid you in your journey going forward. Okay, so last of these simple list with other technical indicators is parabolic saw, much more easier to comprehend compared to Ichimoku clouds. It's a lovely indicator because it encapsulates the rate of change of prices, and it gives you these lovely, what we call pivot points. Okay. You will see what I mean by this in the near future. So these are some that go onto some indicators that go onto your charts. Okay. Which are considered as technical indications. Let's move on to the other branch. Okay. So if you allow me please to visually explain what I mean, what I've done here. So as we just mentioned, we covered charting analysis and mechanical analysis. This, what we just mentioned over this last slide, is the on chart. So it's a further split. Pardon my horrible handwriting skills. Okay. But yeah, so it's a further breakdown of this category of mechanical analysis into on chart and off chart. This is not an official distinction or an unofficial kind of classification. This is my way of introducing these concepts with the most simplest version in order for you to grasp what we're talking about here. Okay, so don't expect to see this breakdown in books and all that kind of stuff. Okay, this is for our own convenience. Okay, so on chart indicators, we have covered that. Off chart indicators is the next leg of mechanical analysis, if you like, at least from our point of view, which has other technical indicators that do not go onto the chart, hence the name off chart. Okay, so in a sense, you have the price action, and then you have a different box below the price action, what we call below the chart. Okay, where you can plot all these lovely stuff and many other stuff, meaning technical indicators, such as the relative strength index. We're going to go extensively into relative strength index. This is one of my favorites, plus McClellan, and you have many other different indicators. Still, it has lovely implications and lovely signals, and either confirms or denies your own biases depending on what's going on. Definitely keep an eye on that. I don't know, that's supposed to be an arrow. Okay, now it's clearly. Moving average, convergence, divergence, definitely another one we're going to deep dive a lot in. Okay, and we will be using extensively 1, 2, and possibly momentum in the near future. These two are my own personal bias. I like to use them on a daily basis. We have to introduce the concepts first, and then we're going to go on a live environment together in the near future to analyze and detect and extrapolate and observe, in a sense, what kind of information they convey. But first, we need to learn how they are constructed. Okay, this is my own personal bias. I like to break these kind of technical indicators into bits and pieces, decompose them in a sense, understand what information goes in the technical indicator in order to understand and get a picture of what is, in a sense, attempting to tell you. Okay, once you don't know the components that go into a pod or a machine, you can run the machine, you can get the machine running, but you don't understand how it works. You can assume this kind of analogy if you have a car. For example, most of us know how, I'm assuming most of us drive, okay? So most of us drive, but not all of us know how the car is actually built or the engine runs. Still, we use them to get by and do our stuff. But if you want to understand how the whole thing works in order for you to drive that lovely car much nicer or more efficiently, if that's the case, you can actually go and inspect each and every aspect of it. At least that's my approach. I love to do this in order to grasp what kind of information does it tell me. And once I understand that, you can apply that. And once you start looking under the hood, in a sense, to see how these indicators are constructed, you're going to see the fallacies as well. You're going to see the problems. You're going to see the issues that are not covering. Okay. And this is the most important aspect of studying this, because they're going to tell you, once you learn how they are built, you're going to learn their limitations. Okay. You're going to understand they're not future predicting, or they know there's not like a glass ball that predicts the future. No, they are simply conveying some sort of specific information, okay, and they're not predicting the future. Okay, you need to learn their limitations as well, okay, in order for you not to assume, oh, you know what, RSI is there and it's going to go there, and that means there's going to be a specific influx of prices, it's going to move to high ground. No, that's not how it works. Okay, they convey specific information at specific points in times, and some are more useful in under specific situations, and others are much more helpful in other situations. So the point I'm trying to make here is that once we go over each and every one of them, you're going to see how they complement each other, and you get a holistic kind of approach to any given period in time in any kind of market. Okay, so you can use that in non-trending markets, or in trending markets. You're going to see them in bull runs or bear runs, okay, or when you're going to see, for example, early indications for a possible reversal, you're going to use specific indicators and not others. Okay, we introduce a bunch of them in order to create synergy between them, okay, in order for you to have this kind of overall knowledge or effect in your own trading. Okay, so enough of me blabbering about stuff. We're nearly near there. So another one is average directional move. Once again, we're going to cover that in depth. And momentum. Okay, pretty similar, not that much similar, but still, they convey what we call, in a sense, the momentum or the tendency of the market or the sentiment of the market. Okay, so other branch, okay, you can fall, this category could have fallen easily under the on chart indicators. Other technical tools that intermediate to kind of expert traders use, not all the time, but on specific points on time, are what we call the Fibonacci indicator, okay, which is split into 4 types, if you will, like, depending upon the situation. So you have Fibonacci retracements, extensions, expansions, and projections. Most traders use retracements on much more frequently rather than, for example, projections. But still, they have their own role to play. Okay, so extension is another one, expansion is another one, retracements is the most common one. Okay, so we're going to introduce the concept of Fibonacci as an indicator. We're going to do a historical overview of how we came up with the Fibonacci sequence and why do we use the Fibonacci sequence in trading. Okay, then I introduce the levels that most traders use, or the critical levels of Fibonacci. And lastly, we're going to do Elliott wave theory, which has relationship with pretty much Fibonacci retracement aspect of things. Elliott wave theory is is a big chapter when it comes to understanding how the whole thing works. It's not primarily used for fine-tune kind of entry and exit points or signals. Is used for you to understand how the markets behave, assuming that they behave in a defined manner that the Elliott wave theory is saying it is. Okay, so it incorporates an element of time and cyclicality. Okay, it also incorporates an element of chart pattern formation and specific kind of structure of waves. You have impulse waves, you have motive waves, corrective waves, and all that kind of stuff. You're gonna see them in action again, nearing the end of the series, this newly embarked series. Okay, because obviously we need to build upon a lot of knowledge and cover a lot of ground before we go into the Elliott wave theory, but it's certainly of utmost importance for you to grasp how the whole thing works. Okay, so what else do we have here? Which approach when it comes to technical indication might work for you? Which might work best for you as an approach? Use on-chart indicators, off-chart indicators, chart patterns, all that kind of stuff for support and resistance levels. In my honest and humble opinion, everything is super helpful because using isolated kind of technical tools for your own benefit without taking into consideration any other available tools, okay, you in a sense are blinding yourself to the overall to the overview, okay, in a sense. So in my own personal opinion, learning each and every one of those topics we have discussed here and the ones that we will be discussing in much more depth over the next few months, and compiling that information and using them in conjunction with each other. So you're going to hear me a lot saying about convergence of different indicators, okay, is the most, or at least the optimal approach from my point of view when it comes to being a successful trader and implementing a sufficiently good enough strategy for you to make money upon. Okay, so the convergence of different indicators, from my point of view, is indeed the best approach going forward. And it goes without saying that not only technical but fundamental analysis is going to be and is a big aspect of trading as well. Again, my own personal bias. I like to do 60 technical, 40 fundamentals. You're going to see what fundamentals means in the next session. Okay. And again, this convergence or attempting to form balance between different stuff or between different indicators, either it's going to be economic news releases and interpreting the results of a financial news release, or whether that is interpreting the current trajectory of or the value of a specific indicator. Using all of this together is the best way, from my point of view, once again, my own biased point of view, of going at trading. Because again, the goal here is to understand how the whole thing works, how the machine works, how everything comes together, and the interrelationships between asset classes and sectors and instruments and all that kind of stuff. If you understand how the whole framework works, or at least you get a glimpse on the cogs of the machine, you can certainly become much more accurate into your own execution, if you will, like, of trades. Okay, so not just blindly drawing lines and not paying attention to what's going on to the wider international scene, financial international scene, or economic scene, and just blindly placing support and resistance levels and trend lines and opening positions and expecting it to go your way, with being blind to the possibilities out there and what effects they might bring to the price action. Okay, so it is a much more built up of self-awareness and vision of what can impact any given instrument's price at any given point in time. And these technical indicators are supplementary to all of this. Okay, so you need to learn the basic first. You have to come up with the formation of an assessment and then putting your plan to work if and only if the convergence of different indicators and financial fundamental analysis is aligning nicely with you, which creates a certain degree of high probability of making money. So remember, trading is a game of probabilities. Okay, the largest amount or percentage of probability you can amass, okay, with your own assessment using all these very pre-mentioned tools, the higher the chances of you being successful. Okay, and we will do that extensively throughout this series. Definitely you're going to see that, me doing that live with you on a session, on a live trading session. Okay, see how the whole thing comes together by going through everything we have learned. It's going to be on the later stages once again. But yeah, hopefully this webinar has been a good enough introduction into the possibilities of technical analysis and capitalizing upon that principle or these tools to make become profitable in trading. Okay, in the next session, okay, we will be doing the same thing but from the fundamental kind of point of view. So you have two main schools of thought when it comes to the trading of instruments, okay, or financial markets. So you have technical analysis and fundamental analysis. We have done the intro on technical. We're going to do the intro of fundamental in the next webinar. And as we progress through time, we're going to be deep diving on each and every one of those schools of thought, nitty-gritty details, and add on to our knowledge. Okay, so this is the overall agenda going forward in order for you to keep an eye out. Okay, so guys, if you have any sort of question, please send them through right now in the chat, because we are indeed reached the end of today's session. Yep, there's nothing else. If not, hopefully we will see you on next week's webinar, which we're going to do introduction to fundamental analysis. Okay, for the time being, I see no questions in the chat. Thanks for watching, thanks for being here, and see you hopefully on next week's session. Take care. Bye-bye.